Hello traders and investors, welcome back to my channel. This is Nick with NJMinvesting. In this video today, we're going to be rounding out the 4 main basic option strategies that you can use in your portfolio. We already went over selling puts as well as how to buy calls and puts. So today we're going to be focusing on how to sell calls, specifically how to sell a covered call. Today I'll be going over what it exactly means to sell a call, the benefits and risks of selling calls, provide an on-screen example that you can follow along with about selling calls, and provide my personal thoughts on selling calls. It's important to know some option basics before you start trading, so if this is your first video, please feel free to use my older videos on the option basics so that you can get caught up with everything that you need to know. As always, I mapped out everything you need to know below in this video as well as in the description box for extra education. Efficiency. So now, without further ado, let's learn how to sell calls on Robinhood. What is selling a call? As a brief overview of options in general, an option contract typically represents 100 shares of an underlying asset that you can purchase at a premium price that is typically worth much less than having to buy 100 shares of the underlying asset at a given time. When you sell a contract, you are designated as a contract writer. In the case of selling a call contract specifically, you are obligated as the contract writer to provide 100 shares of the underlying asset to the option contract buyer that bought your contract at a later date if you are exercised. In many ways, this is similar to selling puts because it also deals with getting your contracts exercised on later dates. So be sure to watch my last video on selling puts for more information on these topics. There are 2 ways you can sell call contracts. You can sell naked or covered calls. On Robinhood, you can only sell covered calls, so that's the strategy that I'll be going in depth with you today. The reason for this is because in a covered call position, you already own 100 shares of the underlying asset, meaning that you're covered. This prevents you from having to buy the underlying asset at a later date, possibly for a higher value, and most importantly, it prevents you from having to borrow any money or margin from your broker on a later date. The 100 shares that are required to write a covered call position are known as your collateral. What this collateral means and how it will be used will make more sense once I explain more about selling call options. When you sell a call contract to an options buyer, you collect the upfront premium that the options buyer put down to purchase your contract, while also placing up the 100 shares that you have in your possession for collateral. In the case for most traders, you will want to collect back your 100 shares that you put down for collateral and just collect the premium price. So in this case, a favorable interaction in this trade would be if the underlying share price ends up lower than our strike price after the expiration date. In this way, your contract will not be exercised and you get to keep the initial premium that you sold your contract for, as well as the 100 shares that you had to put down for collateral. However, if your underlying share price goes above the strike price of your contract after expiration, then you have a chance of getting exercised, and in this case, your 100 shares get taken from you. However, it is good to note that in this case, you will get paid for your 100 shares at the strike price of your contract. You want your underlying share price to drop below your strike price of your contract. However, you don't want the entire stock to be consistently bearish over time, because this could spell disaster if you're holding 100 shares of the company. So what are the benefits and risks of selling calls? Let's first get into the benefits. Selling covered calls allows you to collect weekly or monthly premium from shares that you may already own. Say if you have 100 shares of an underlying stock like Microsoft, a blue chip company that is very reliable in having progressive growth throughout the years. If you sell a covered call that is way out of the money, then you have the security of knowing that you own 100 shares of Microsoft while also benefiting from the premium of the sold contract. Even if things don't go your way in this scenario and your underlying share price goes above the strike price of your contract, then you don't really need to worry, as these 100 shares will be filled at the strike price of your contract by expiration. This means that you can benefit from Microsoft's share price going up in value, but to a certain cap. And as an added bonus, you also get the premium of your contract that you sold. So what are the risks of selling call contracts? Selling covered call contracts requires a lot of upfront capital invested in the shares of a company. 100 shares in any company isn't necessarily anything to sneeze at, and 100 shares in a blue chip company that's super popular like Microsoft could even cost you anywhere around $20,000 to own that amount. This is especially nerve-wracking for smaller trading accounts that might not have enough upfront capital. However, it's always good to know that in the case for covered calls, even if the contract doesn't go your way and your contract lands in the money by expiration, you still benefit from the premium of the contract that you sold, as well as the share price of Microsoft going up to a certain cap. The worst case scenario for covered calls always goes back to your research, belief, and performance of the underlying company. Specifically, if you were to buy 100 shares of a company at a high point because things are going well and all of a sudden bad news comes out and the share price drops drastically, then you are considered a bag holder. This means you played yourself, my friend. In this case, you could sell covered calls as you have 100 shares of the underlying stock. However, the premium prices for your contracts might not be able to cover the amount that you initially lost from the share price going down. In the riskiest and worst case scenario, you could lose a lot of money by selling naked calls. In a naked call position, otherwise known as a short call, you are basically selling a call while still having the obligation to provide 100 shares to the buyer without actually having those 100 shares. Thankfully, brokerages like Robinhood don't even allow you to sell naked calls, as the risk of you having to borrow money or margin on a later date is increased. However, if your brokerage does allow you to sell naked calls, then this is your warning. You are warned. Be careful. If your contract lands in the money and your options buyer exercises your contract, then the difference between your share price and your strike price will always be a loss to you. Now let's go into some on-screen examples of selling calls on Robinhood. You can follow along with me on screen here, and if you're interested in signing up with Robinhood as a brokerage, then check out my older videos on that. Let's open up the Robinhood app and go to Intel or INTC. This will be an example of how selling calls can be risky. Once you're in the stock screen, I want you to notice something with their graph on Robinhood. If you look at the drop between July 23rd and July 24th, you might be wondering what exactly happened. Well, in short, this is what happens when bad news comes out, especially during earnings season. In this case, Intel essentially dropped the ball, giving massive delays to their 7nm processing chip, which their competitor, AMD, already has in production. Because of this extremely disappointing news, investors essentially jumped ship to AMD. Now, going back to selling calls and how this could potentially hurt you as an investor, is if you bought 100 shares of Intel C on July 23rd before this dip happened. If you bought 100 shares at $60 a share and experienced this $10 drop, then you potentially lost a lot of money. And if you look at the average premium price for selling calls in this case, they all typically are under $100, meaning that it could take you multiple weeks, up to maybe even 10 weeks, to recover from this initial loss that you had. Let's now get out of this nightmare scenario and go to more positive outturns of what you can expect when selling call contracts. Type in Microsoft or MSFT, and you can already see by their graph that they're a relatively stable growth company. Now let's hit trade, then trade options, and remember to hit sell call at the top of the page. Now, some favorable things to look out for when selling calls are as follows. Remember to look at closer option contracts, as theta is on your side and the movement of time is disadvantageous to option buyers, but very advantageous for you as an option seller. Next, it's good to think about whether or not you'd like to keep the 100 shares of the underlying stock of Microsoft, or if you'd like to risk your 100 shares for more premium. If you'd like to keep the 100 shares of Microsoft and look at strike prices that are way out of the money, but if you don't mind getting more premium for your contract and possibly giving up those 100 shares to an options buyer, then look at strike prices closer to the current share price. To sell a call contract on Robinhood, first go to a strike. In this case, I'm going to be using the 210 strike. Type in the number of contracts you want as well as the premium price you would like for your contract, and hit review, then submit. However, do note that if you're not able to produce a covered call position on Robinhood, meaning that you have 100 shares of the underlying stock, then in this case, you're not even able to write a call contract. And this is because Robinhood doesn't allow you to write naked call positions in order to limit your risk. Do note too, and don't be alarmed if your underlying share price goes above the strike price of your contract before expiration. This number will continuously get more and more negative as the share price increases. However, don't worry in this situation. In the case where your covered call contract lands in the money, you will be credited for the 100 shares at the strike of your contract after expiration. Personally, I think that selling calls is a very similar strategy to selling puts, as it allows you to have favorable upside in certain positions. Just be careful when you are selling naked calls, as this increases your risk exponentially. The main thing here is to invest in companies that you believe in and that have stable growth over time. I personally love investing in Microsoft, as it's one of the companies that I don't necessarily need to monitor too much, but have provided me great returns. If I had enough capital to buy 100 shares of Microsoft, then I would be utilizing the selling call method in order to be making more premium profit off of my investment. When the underlying company is stable and is essentially a blue chip company in Microsoft's case, then I believe this is a win-win strategy for you. Always remember to invest responsibly and research well before you buy a position into a company, especially 100 shares into a company. In the case where you get hit with a major drop after bad news such as Intel, you could be bag holding the stock for a long time. And with that, we're going to be wrapping up the 4 main basic ways to be trading options on Robinhood. How to buy and sell calls and puts. If you like this video, then please feel free to like, subscribe, and hit that bell for notifications. My next video will be about the wheel strategy, which essentially combines selling calls and selling puts together. As always, I hope you enjoyed this video today. Let's continue to grow with your investments. Peace.